To start off, actually, Dion,
Sure.
you said something cool, and I think I'll always remember this, and always pair it with you, because I think you share it regularly in your presentations. Is you say if you love your kids, get them an RESP. If you really love your kids, buy them a house.
Yeah, something along those lines. Yeah.
Is that still accurate today?
Yeah, I mean, it's just compound interest and the fact that a bank will allow you to start with more in real estate than borrowing. Like this, you can't borrow money to invest in an RESP using the RESP as security,
Hmm.
but you can borrow money to invest in a property using the property as security. And an RESP, the starting point is zero, and then maximum $200 a month contribution. With an investment property, the starting point, probably around $500,000. So it's not rocket science when you can start with $500,000 versus $200 over a period of 20 years. Of course, the house is going to win. And it doesn't even mean that the annualized return in the property market is greater than in the RESP, investment. It's just a matter of the fact that you have the ability to start with a greater number because the bank will lend you so much money to buy property.
Hmm. So I didn't realize that you can't. So there's RSP loans, right?
Right.
That's not the same for RESPs.
You
Those don't
know,
exist.
I can't say for certain, but I've never heard of an
Right.
RESP loan. Yeah.
Well, if you haven't heard of it, that's
Yeah.
I'm guessing
It's a fair
90% of
indication.
people haven't heard of
Yeah. I don't know. If
it.
anybody listening has ever secured an RESP loan, let us know.
Yeah, let us know. We'll take some
Mhm.
money. We'll take some free money because we're in the same boat. Like we'd love to do some RESPs too. We just haven't. It doesn't scale. I think that's the biggest thing.
Yeah.
It doesn't scale, so it's not worth our attention. Hence, that's why we haven't done it yet.
Yeah. I'll give you a quick analogy. I got a client of mine who has three kids and
Hmm.
was contributing $200 a month into an RESP for each of his kids.
Hmm.
So it was draining his household $600 a month. And he was doing the responsible thing that most Canadian parents are taught to do. But $600 a month hurts quite a bit. And in place of that, he bought one investment property, which cost him nothing per month. And when you looked at the projected returns over the same 20-year period,
Hmm.
the numbers were greater. So one property looked after three kids
Right.
without draining him $600 a month.
Right.
Yeah.
I think it's pretty safe to say what the better investment is, but we'll let everyone choose for themselves.
That's right.
I don't like giving financial advice on people. It's just more like if you're interested in real estate, we can guide you on that process.
Yeah, it's not really financial advice. It's a question to really compare
Hmm.
and I ask this of all my clients, which is ask yourself, are you really doing the best you can with what you have? And you can only make a decision on that if you have all the information. And the reality is your financial planner is not going to teach you about real estate investment.
Not the
What
one
you
that works for
got?
the bank. I have to plug in. This is live, right? So I could see my battery's draining. It's not going to make it, so I have to plug
Okay,
in.
sure.
This is the benefit of being live. You see it when we when we goof up. So Dion, so say so actually take a step back. You're a member of Butler Mortgages. You guys apparently you guys are number one again this year.
Yeah, I think so.
That's crazy. There's a lot of mortgage brokers out there.
Yeah, and we don't have a massive team. That's the other thing. There's teams out there of hundreds of people. I think our core team is something like 7 or 8 agents.
Right.
Yeah.
I remember I was talking to another mortgage brokerage owner at an event, and she was saying they're number one and how they have like 300 plus agents.
Right.
Right. So would you rather be the one with 300 plus agents or the one with 7 or 8 active agents? Because I know how managing people is not an easy thing. Anyone who has managed people, including even real estate investors who manage like contractors and tenants, it's not the easiest thing. So
Yeah, we get people, I mean, on a weekly basis, I get other agents approaching us wanting to join, but Dave Butler has a very high standard of who who's allowed to join our brokerage. They have to have done literally hundreds of deals before they can come in.
Right,
So,
right.
yeah.
So actually, talk to what makes Butler's different. For example, what percentage of investors do you work with versus
Yeah,
everyday, I don't know, I don't want to call them vanilla, but,
sure. So the majority, meaning that last year I closed about 160 mortgages, and probably 130 of them were for the purpose of investment, meaning that people approached us because we are known in the industry as the investor brokerage, and in many cases we'll help people acquire multiple properties even in 1 year. So that is our focus, and a lot of that success of the volume of business that we do comes down to the fact that anybody who's purchased property in the last couple of years has done very well. Their equity position has increased significantly, and then they'll come back to us and acquire more. So in my experience, when a person buys their first investment property and they hold it for 6 months and they see that everything that they had hoped does in fact work out,
Mhm.
they'll actually have the confidence to then go out and continue to buy.
Right, right.
So the first one is always the scariest
Yeah.
and maybe the hardest. And after that, most of our clients kind of end up with around three properties. Some have a lot more, but three seems to be the number which gets them to a net equity position of around 2 million by the time of retirement. So
That's not bad.
mm,
3 properties to get to 2 million.
yeah, I'm happy to break those numbers down if you want.
That's amazing. And actually, before you do that, actually, I would love to hear that. Before you do that, though, for context, I want people to understand. So, a great baseline I always like to use because everyone understands teachers and pensions. Like everyone knows a teacher. You know, we've all been taught by people. Our kids are taught by teachers, and if they work for public or Catholic board, they all have pensions, right? Teachers' pensions.
Right.
And I've read online a teacher's pension is worth somewhere between $2 or $3 million.
Okay.
That's like the cash value if you were to sell your pension. So you're saying
Right.
3 properties gets me the same as what a teacher has to, because like teachers get a bad rap. It is a tough job. They have to give up. I think they have to work for like what 30, 45 years in order to earn that
Something like
pension. That's a
Yeah.
long time, right? But you're saying it's just 3 properties to get you something close to a teacher's pension.
Yeah. I mean, look, the thing is we are in a market and we have no control over that market, but we can look to history and we can look to economic fundamentals and make some pretty educated guesses as to where prices will be based on population growth and job growth and just demand for property. But I'll give you the quick numbers. So an average client today, if they're buying their first investment property, is probably buying a property for around $500,000. And when they buy that property, the down payment, the 20% down payment, the 100,000 that they put down on that property, is usually borrowed money, borrowed usually from the equity in their current home
Mm-hmm.
through a home equity line of credit.
Mm-hmm.
So they'll borrow 100,000 for down payment. Then we'll get them a mortgage secured against the property they're buying for 400,000. So on day one, you're starting with an asset worth 500 and a debt of 500. So that's day one. Now, as time goes on in the world of investment, and I encourage your listeners and viewers to check out or Google the rule of 72. The rule of 72 shows us that at an expected rate of return, how long it takes an asset to double in value. So in the world of real estate, we use the number of around 5%. Some areas will be greater, some areas will be lower. So do your research on the area in which you plan on buying. But at 5%, property prices double about every 15 years. Just under, but we'll call it 15 years. And so a property worth $500,000 today, in 15 years should be reasonably worth $1 million. And whenever I tell this to clients, they always start to question that number, and that's fair because that's a pretty big jump.
Yeah, it's a lot of money.
And the real way to assess that is to look backwards and say, if I'm buying this property today for 500,000, what was it worth 15 years ago? And half that number is obviously 250,000. But in many cases, because of the significant growth we've had in the last 10, 15 years, likely the number was probably closer to 150 to 200,000. But if you want to figure out whether this future projected number is true, maybe just look back 15 years.
Mm-hmm.
So if it's true that in 15 years this asset's worth $1 million, and also we started with a debt of 500, but over that period of time the debt load has dropped to probably around 300,000. So we've got an asset with $1 million with 300 debt, so we've got a $700,000 positive net position on that piece of real estate.
Mm-hmm.
And so with simple math, if you have that position on one property and you can acquire 3 and have the patience to wait for 15 years, then 3 times 7 is 2.1 million.
Right. I need more houses.
I think you've got enough.
Nah, I have issues.
You have way more than 3.
Yeah, I have
3
issues.
with a couple of zeros behind it.
No. I've actually been bad about ignoring my portfolio and trying to grow these other businesses. But we're back in the growth phase. We bought 2 properties last year, I think, somewhere around that. Great. 2 properties last year. We're closing on one in April.
Okay.
And then we're really busy, but my team sends me deals and I'm like, I want that. It's not healthy. I have issues.
Well, if you're going to collect something, you may as well collect houses.
So you mentioned 3 properties. What is the sticking point for people to do more? Like you said,
no, there's really no sticking point. Okay. It just seems to be the number that a lot of people are comfortable at.
Okay.
But we have other clients who really want to pursue real estate. Mm-hmm. See, for those people who are buying 3, it's just an alternative or a supplement to what they're currently doing. Mm-hmm. Then we have others who really want to use real estate as a tool for freedom from the 9 to 5, and or just want to go big. Mm-hmm. They're happy with their job, but they just want to go as big as they possibly can. Mm-hmm. And for those people, we'll push to 10 plus properties. So there are clients amongst us that have more than 10 properties.
Right. What is someone's financial profile look like in order to qualify for 10 properties?
Yeah. So the first thing is that, well, for any investor, the first and most important thing is credit scores and credit load, down payment, and income. These are the 3 key factors when applying for any mortgage. And we want to ensure that, you've got good credit. Ideally, your credit score is above 700. Some lenders prefer those scores above 730. They will then allow us some better debt ratios. Also, in terms of that credit, we hope that you're not carrying too much consumer debt because, many a time I'll have clients come to me and they make excellent household income, maybe $200,000 a year, which is great, but they each drive an Audi with a $1,000 per month car payment. And that then negatively affects their ability to take on more debt. So sometimes we have to, restructure stuff and or encourage people to maybe pursue cheaper vehicles. I'll share with you, I just crossed over $200,000 on my, 200,000 kilometers on my 2006 BMW X3. And I think I'm going to drive this thing until it dies because it doesn't owe me anything. It doesn't cost me anything. And it's a great car.
Nice.
So, I know that every other ad on television is for a car.
Yeah.
And that they work because everybody feels they need a new car every 3 or 4 years. Mm-hmm. I don't need that personally. Mm-hmm. But yeah, debt load is a big one. Income and equity. So I'll tell you what most of our clients' positions are. They have a house where, they don't have to have a very expensive home. Let's say the home that they reside in is $600,000. And they've been in the home for some time and they have a mortgage on the home of around $200,000. That's kind of like my regular client. So they've got this positive position of $400,000 of equity in their home. And while that's nice that they have that, we can't access all of it. We will go and access 80% of the value of that home. So in this example, 80% of 600 is 480,000. So if they've got the ability to access 480, but they've got an existing mortgage on it for 200, it means the difference here, which is 280,000, is what we can access, and that becomes what we call our working capital. So we can initially create the working capital for our client, and then with that 280,000, we can then start to look to buy property. Some clients come to us with a misconception that they're not able to buy more property until their principal residence debt is paid down to zero. So if there's anybody listening who feels that way, just know that that's not the case. We can take on more debt even though you have debt on your principal residence. But then that begs the question, okay, how can we afford this other property with another couple of $100,000 debt in addition to the debt we've just created on our principal residence? And the answer to that is that the lenders will recognize the monthly rental income and utilize that monthly rental income to offset the monthly cost of ownership. So the best way to look at it is kind of like a business unit. Like if you go to the bank with a business proposal and say, okay, here's my business, and every month it's going to cost me this much to run, but I'm going to receive this much revenue, and the revenue is greater than the expense, then a bank will usually lend based on that property being somewhat self-sufficient.
Mm-hmm.
And this is how people can continue to buy more and more property. So if we go back to our example where we've got these clients who've created $280,000 of working capital, and we want to buy a property for $500,000. Well, from the 280, we only need 20% down on this next property, so we only need $100,000 down payment, and then we can go fund the rest over here. After that deal's closed, your client will still have $180,000 of working capital, and so we could effectively go and do that again. And so this is how our clients go out and build portfolios.
To your point about HELOCs, what percentage of your clients are using a HELOC for the down payment?
Yeah, the majority are. So that's the home equity line of credit. We'll also have a conversation about the fact that, you're accessing, in this example, 280,000. A home equity line of credit is always going to be at a higher interest rate than a regular, say, 5-year mortgage.
Mm-hmm.
If we know that our client is definitely going to need 100,000 of this 280 in order to purchase another property fairly soon, then we would actually access that 100,000 as mortgage money because we can get it cheaper.
Right.
So what would happen is of that 280, we get 100 as a mortgage and 180 as available line of credit because we know we're immediately going to deploy that 100,000 into a purchase. So yeah, that's a conversation that we would have on a case-by-case basis with the client because just the flip side of that, the benefit is it's cheaper on the interest rate, but the monthly payment on a mortgage than the monthly payment on a line of credit because a line of credit only requires you to pay back interest, whereas a mortgage would be principal. So a little technical, but I would talk to clients on a case-by-case basis and advise them based on their particular circumstances and needs.
Interesting. I actually think many people don't understand that. Like you're saying, how people thought they had to pay off the mortgage completely in order to get HELOCs.
Yep.
Do you see it a lot? Because I actually think a lot of people never think to use their HELOC or many people don't even know what a HELOC is. So they don't even know that's an option for them in order to find that down payment for a property. I think this group who are listening they're not that group of people, sure. But I wouldn't be surprised if like 60% or 80% of the population didn't realize most investors are using their HELOCs for down payments for investment property.
Yeah. And so for those who are listening and understand this concept, then just know that 60 to 80% that Erwin is referring to are your future joint venture partners.
Yeah, or and your tenants.
Right.
So anyway, for anyone who's watching, go ahead and comment your questions. Travis, I'll get to your questions in a second. Actually, we might as well try to get to it now. I think Dion's probably going to need some more context. So let me. Can you see it on the screen? I'm going to put it on the screen, Dion. On average, how long does it normally take to refinance a property and pull out the initial investment or part of it?
Start to finish, about 30 days.
30 days. So I'll give my example. You can comment on it.
Sure.
For example, I'm a difficult case to lend for. Having as many portfolios and reporting what income I do as a self-employed person, it looks like for the property I'm looking to close on in April, I may trying to get B lender money. So Travis, this again, and need more context for your question. So this, you may have to take this offline with whoever you're working with for your mortgage. But in my example, I'm difficult to lend to. I'm likely having to go to a B lender if they'll take me, and then once I'm done the renovation, which will probably be 30, 60 days, I plan on breaking that mortgage and getting a new one, likely with the B lender again, in order to pull my renovation money out and some of my equity out. So in my case, I hopefully 60, 90 days, I can do a refinance, right? So it really depends on your strategy. If like Dion, if you're talking like a buy and hold, you buy a turnkey property, you're doing a buy and hold, how long would it take to refinance that kind of property?
Well, so buy and hold means that you're financing a mortgage for the purchase.
Mm-hmm.
When you say refinance, is it because you've added value?
No, that's my point. Is we don't have enough context to really answer this question properly.
Okay.
Because, for example, in a rising market, in the past market that we've had, where there were prices were going up 7, 8, 10% a year, we had clients breaking their mortgages after 3 years.
Right.
Because old school, a lot of us did 5-year terms. What are people doing now for terms usually?
Yeah, most are still taking 5 years.
Right, right.
And I can tell you that 2 years ago, almost every mortgage we did was a variable rate mortgage.
Mm-hmm.
And now, and that's because the spread between the fixed and the variable was close to 1%.
Mm-hmm.
And now that spread is less than 0.25%.
Mm-hmm.
And so many of our clients are choosing to take a 5-year fixed in the current environment.
Right, right. Sorry. I'm just going to try to finish off with Travis. So again, we'll need more context to answer your question properly. But in the past, I've seen as soon as 3 years for a refi, which is basically just the market bringing up the property value. Old school, we were always doing 5 years. Like when I started investing back in like '05, we wouldn't do refis until our terms were up. So 5 year. So as long as the market's going up, then you should, and your tenants are paying down your mortgage. We plan for 5 years. We actually don't plan for much in terms of refis, except for cases like our current property that we're closing in April, which is a significant renovation that we plan to do a refi right away. And also to give some more context, the house is ugly, so it's below market value. Hence, there is upside in order hence there's upside available to us to be able to pull money out for a refi. So Travis is giving us some more context. So his question was more meant for converting a single family into a duplex. Have you ever seen one of those, Dion? Have you dealt with many legalized basement apartments?
Yeah. So I'm myself.
Every single day, he says.
Yeah, it's a strategy that a lot of our clients are employing right now. They'll buy the bungalow for $400. They'll spend $80, so they're into it for $480, and we'll then get it appraised for maybe $550.
Mm-hmm.
So the uplift in value there, $150,000.
Mm-hmm.
And we can then go and access 80% of that uplift.
Right. So can you break that down? Who's giving the initial financing, or are people buying cash? I should actually bring that up. Is back in the old days, back into like 2005, 2007, when things were really cheap, we could honestly buy stuff entirely with our HELOCs. We could close with HELOC money, and then we'd we'd use HELOC money to renovate, and then we would go get our mortgage and bring it back to 80-20 loan to value.
Yeah, so nowadays, no, we actually close. So I'll use some round numbers to make this simple. For clients buying a property for $400, we will get, and they're going to renovate it.
Mm-hmm.
we will go in and close on it with a mortgage
Mm-hmm.
at 80%, which
Mm-hmm.
would be $320,000 mortgage. The client would then use their own funds, usually again through a HELOC, to go and do the renovation. And let's just say that after reno, the value's been increased to 500,000. So that we purchased for 4, it's now worth 5. Right? So the increase is $100,000. We can go back to the same lender who gave us the mortgage to buy the property, who gave us the 320, and say, hey, look, send the appraiser in again. The appraiser hopefully confirms it's worth 500, confirms that it's up $100,000 in value, and we can ask the same lender for an extra $80,000. And this is important, Erwin. We do not have to break the mortgage we initially got to purchase the property.
Great.
So there's no restructuring needed. It's just a secondary portion with the same lender. And we can take that extra 80 grand as a mortgage, fixed or variable, or as a line of credit.
Oh, what are the rates on that second portion?
Whatever the rates are in the market at the time. So we can take a fixed 5-year, a variable 5-year,
Right.
or a home equity line.
Right. But it's treated as as part of the first?
It's kind of treated as a first. So it's because it's the same lender.
Yeah.
They have control of first position.
Mm-hmm.
So whereas if you go to a second mortgage lender, then they're going to be charging 7 to 10%.
Right.
Yeah. So this is the way that we help most of our clients with those types of conversions.
Fantastic.
Or where they're adding value. Yeah.
Because for the listeners' benefit, because if you had to break a mortgage, it's 3 months interest. And actually, can you walk us through the calculation for 3 months interest? Because it's often not what people think it is.
Yeah. So if you know that you're going to break a mortgage, or there's a higher chance, and we'll often ask the client, is your intention to hold this property for 5 years? If it is, then you can go fixed or variable. If you know for certain that you're going to break it, then you might take a shorter term. You might take a 1, 2, or 3. Or if you want a bit of flexibility because you're in the middle, you're not sure if it'll sell and you're not sure if you'll keep it, then you might just take a variable mortgage.
Mm-hmm.
And that'll let you walk at any time within the 5-year term at 3 months interest. So if we're taking a mortgage on that, say, that $320,000 mortgage that we just discussed on that $400,000 purchase, let's say that your monthly payment is somewhere around, we'll call it $1,400. Okay. It would be fair to say that about 8 to 900 of that 14 would be interest. We'll just call it 800 for today. So a little bit more than half is interest.
Mm-hmm.
And when you break a variable mortgage, they'll take that interest component of your monthly payment, so $800, and they'll multiply it by 3 months, so $2,400. And that would be the cost to break your variable mortgage.
Thank you. Because I actually had it wrong. I don't know if I'm the only one, but when I first heard 3 months interest, I thought what the interest would be across 3 payments. Like what's the interest portion of a payment for 3 months?
No, that's what I just explained.
Oh,
no, that's exactly what I just explained. You had it right.
Oh, yeah, good. And also, so folks don't understand as well, not all variable mortgages are 3 months. I've actually seen some that are way higher.
Yes. And this is where, like I say, like getting a mortgage is like getting a car, because you can get a cheap one and they're easy to get into, but they're hard to get out of sometimes.
Yeah.
Or they don't have brakes.
Yeah.
Right?
This is where people read the fine print. Just because people will choose based on the sticker price, and then when they try to break it, it's like, oh no.
Yeah, so there are super cheap rates that exist, but in the fine print they say there will be a 3% interest penalty. Meaning, in that same example where the penalty might be $2,400, if the penalty was 3% of your outstanding balance, that penalty is approaching $10,000.
Right. So in your example of a $400,000 house, $320,000 mortgage.
Yeah.
It's $320,000 mortgage times 0.03. That's $9,600.
Yeah.
So, yeah. And the sad part is that I don't think this is usually flagged for people. They just see the great rate and then they sign.
Yeah, I mean, I in my business, the number one question I get every day? Well, often is, what is the interest rate? What's your best interest rate? And what people are really asking is, how can I save the most money?
Yeah.
And so if we look at the bigger picture, the bigger question, well, that's the cheapest interest rate, but what if life events happen and you need to exit this mortgage? Here's the differential in penalty exit.
Yeah.
And then, I'll let the client make that decision. But I think, and you probably apply this, whether you call it by this name or not, I call it the family test, meaning that would I sell this product to my family?
Yeah.
And if I wouldn't sell this product to my family, then I'm going to go out of my way to explain to my client why, even though it's cheap, it's not what I would recommend.
Okay, folks, we're running up on our time limit with Dion, so feel free to ask more questions. So let's jump to James Witter's question. I'm going to put it up on the screen and read it to you. Oops, hang on. What type of documentation do lenders require for proof of rental income? And how much does this affect the mortgage one will qualify for?
Yeah, that's a good question. So it varies. If you have a few properties, 1 or 2 or 3 properties, then just a lease for each of those properties is usually acceptable. Well, hang on. And it depends on the lender. So at the easier end, a couple of leases is all you need. There are other lenders who, in addition to leases, will also need to see your T1 general tax returns. And they'll want to see that the numbers that are reporting on the leases correspond to the money that was declared on your T1 general as income for each of those properties. And then let's just say that you haven't filed taxes because you bought a property in January and now you're applying for another mortgage in September. So you haven't filed your taxes. So in those cases, some lenders will ask for your bank account for proof of rental deposits. So the answer is all of those things or some of those things depending on the lender.
So not so actually, to add to that question, what if your intention is to, so say you buy a property, it's typically we buy property that are owner occupied and our intention is to suite the basement. So our intention is to get income from the property. How does the lender treat that? Do they qualify you based on a snapshot of today, or will they compensate for future income?
So again, it depends on the lender, but in most cases, it's as is current value. And I'll tell you why. The lenders always have to assume worst case, meaning that, sure, that could be your intention, but what if the day after you take possession of this property, something terrible happens, you lose your job, you're not able to actually execute on your original plan? And so they have to protect their position and say, okay, we can't factor in future basement rental income, so we'll go off current rental income in most cases.
Damn.
Sorry, it's the truth. Truth hurts sometimes.
Okay, so here's some other cases. How is income treated? Say you're buying an existing triplex. So in Hamilton, it's extremely rare to find a legal one. So what would the difference be between a legal triplex and a non-conforming, and then so legal non-conforming and then just straight non-conforming?
Okay. So the good news is, as hard as things have, generally changes in the mortgage world make things harder for us. But in recent years, in particular with this particular question, things have got a little easier for us. Because the lenders that we work with, some of them will in fact recognize rental income from separate suites, regardless of whether they're legal non-conforming or legal, as long as they have a separate entrance, a kitchen, and a bathroom. If one of those 3 things is absent, then we can't call it a suite, but we will actually get appraisers to give us rents. And I mean, the simple one is the bungalow with the basement apartment. If you line up 100 of them, how many of those are legal? Fewer than 10. But the good news is that the lenders we work with will allow us to recognize basement rental income on all of them, as long as they have separate entrance, kitchen, and bathroom.
So I have some more questions before I get to Travis again. Are any lenders allowing credits on closing? Like, I don't remember the old days when we used to ask for closing costs or
Yeah, short
even,
answer is no.
yeah,
Short answer is no.
nothing,
Yeah.
eh? No, even like a
If
rebate
there's a
for,
credit,
yeah,
then the lenders just simply take it off the price that you paid
yeah,
and fund you proportionately.
right.
Yeah.
That's another great example of how things haven't gotten easier for the most part. Something got easier recently though. I can't remember it though because I'm an optimist. Do you remember something recently happened that was on the positive that we hadn't seen in a while?
Well, rates actually dropped.
Yeah,
They
there's
went,
that. There's that. Yeah, rates
yeah.
dropped.
So, you know, rental rates were approaching or actually tipping over the 4% mark
Hmm.
about 6 or 8 weeks ago. And now they're, closer to 379, 369, depending on the lender.
Hmm.
Yeah.
Excellent.
So that's a good thing.
I don't know if you see the comments. So we have one comment. It's not a question.
I can't start now.
Dion, one of my favorite humans. Great guest, Erwin.
Oh, who's that?
Shauna Arnott.
Oh, hey, Donna.
Someone apparently thinks Dion rocks.
Oh, cool.
That's Tammy DiTommaso.
Oh, hey, Danny.
So hang on. So I have my phone because I can't have Facebook up at the same time. So that's why you
Oh,
see me
yeah.
looking at my phone for the
That's
calculator
fine.
to, even though I'm Asian, I can't just do simple math in my
Come
head.
on.
Hey, we won't go into like racial stereotypes.
There's a reason they're called stereotypes.
So we have a question. How does rent/cash flow from your rental properties contribute to your TDSR? Is it self-sustaining in actual cash flows?
Okay.
How does it, hang on. How does it impact your TDSR? I heard for your first rental, only half of the rents are added. Why is this the case? We have someone who's been
Well, I can
studying.
tell you that client is dealing with TD or
Ah,
CIBC,
ah,
because that comment would be accurate for those lenders.
yeah.
But there are other lenders who will recognize a lot more
Yeah.
on your very first rental. And you need a good mortgage broker to figure out who does what.
Okay, so I actually don't know the answer, but I'll ask you, why, does it say first property? Yeah, first rental. Okay, so why wouldn't you necessarily go to TD or CIBC for your first rental property?
Yeah, and it's because their rental formula changes depending on how many properties you own. Why? I don't have an exact answer, but if I had to guess, I would say that if you own one property, you're more of a hobbyist in the world of investment. Whereas if you own more than one, maybe you're more of a professional type investor, and therefore they're willing to offer a more generous calculator for those who are buying more properties. So with TD, that kicks in at the second property. With CIBC, I
Mm-hmm.
believe it kicks in at the fourth property.
Mm-hmm. Then the question would be, who do you recommend as your first lender then? For someone's buying their first investment property?
Truthfully, the answer is it really depends. It depends on their personal circumstances.
Got it. Is there a majority answer? Who are the
Not
majorities?
really. No.
Really? Damn. I hate it when that happens, but I totally understand. Just like Travis's question that we didn't have enough context for to answer properly.
Yeah.
So we're getting more questions. Zach Wilms, do you work with / know any lenders who will look at rental income for Airbnb or other STR, short-term rental, when doing a refinance? Excellent question.
Great question. Answer, straight no.
Yeah. What's the reason for that? Is that a zoning thing? Because it's not the legal. It's
It's
a
less
house isn't
about
a
that
hotel.
and more about stability of income. Remember,
Ah,
banks want boring, stabilized income. And I
right.
have clients who have cottages and they rent them on the weekend and they make $3,000 in a weekend, and that's great.
Yeah.
The bank doesn't care. They
Yeah.
just want to know, what would this property rent for as a stabilized
Right.
rental to a family who lives and works and have kids in school around
Yeah.
the corner. That's the income that they're most concerned with.
Right.
And there are ways to deal with that, but I have to talk to that client directly to find out more about what they're doing,
Right.
and figure out how we could present that information.
So say your Airbnb does $3,000 a month. They recognize zero.
If you put forward that you're doing Airbnb,
Right.
that's the beginning of the end of your mortgage.
Hereby, everyone be warned if you're filling out your own mortgage applications. uh, would an accurate analogy be like Airbnb income would be treated similar to like a salesperson's commission income? Because that's treated differently too.
Yeah, I mean, if you wanted to draw similarity, I
Yeah.
suppose so.
Or
Yeah.
like someone's bonus. Like I used to get paid a bonus whenever for IBM. Like how would the lender treat the bonus? It's not
See, there's that stereotype again.
which one?
Asians worked at IBM.
I
I'm
won't.
joking.
I won't add to that. I won't add fuel to the fire
Don't fuel the fire, my
because
friend.
I'm thinking about all the racial profiles of everybody that worked there, and I won't confirm or deny.
They look like you and me.
Dude, we worked in risk management,
We
so
got
it's like
out. We got
math,
out. You and me, we're the two that broke out of there.
math and
So
tech. Who do you think they all are?
yeah, so it's just stability of income when it comes down to the Airbnb stuff. And, the higher level of management, the fact that, you're going to have a higher turnover,
Hmm.
you're almost running it like a hotel,
Hmm.
which converts it to more of a business,
Hmm.
right?
Hmm.
And if you really want to go down that path, understand that your application no longer looks like a regular residential mortgage application. It looks like a business application.
Got it. And that's the
Like you could
downfall,
buy a Subway store or whatever.
right? Is the treatment similar for like a student rental or a lodging home?
Yeah, so student rentals and lodging homes are a very tricky part of the business, but there are lenders who will happily lend on those properties because they have specialized lending products
Right.
that are set up for student rentals.
Right.
So it's important to know at the outset what's going to happen, like what will the appraiser see when they go to the property.
Hmm.
And I've had actual cases where a client was not intending to do student rental, but because, Mohawk College was around the corner and a comment made it in the appraisal report that,
Hmm.
this street is known to be a student rental street,
Hmm.
that, that's sometimes sent an application sideways as
Yeah,
well.
I've had that happen too.
So, yeah. So we need to know not just the property, but the neighborhood, the proximity to, universities and things like that. We need to know that early so that we can deal with those issues before it's too late, so to speak.
Hmm. Hmm.
Yeah.
We had exactly had that. We were applying for a mortgage for a house in St. Catharines that was 15-minute drive to the university, but it's on a street called Jacobson, which is like the most infamous street for St. Catharines for student
Right.
rentals, and that made it into our appraisal report, and that didn't go over well.
Right.
Even though we bought it owner occupied, we bought it off a nice old lady, but just because that made it in to the appraisal,
Wow.
yeah, that
Yeah,
that
it
made things
happens.
tougher. So again, we're Dion's being very generous with his time. Any final questions folks want to ask Dion before we let him go? I think we're good. Dion, thanks so much for
Good.
doing this on short notice.
You're welcome.
Any
You're
final
welcome.
thoughts?
Yeah.
Actually, no, I want to ask one more question. For your clients who are like, okay, so actually, no, I have two questions, if you don't mind. What percentage do you think of investors are like your hobbyists, like the 1 to 3 properties, versus what percentage are them are the ones who are going for like a career and income replacement?
Yeah, I would say, okay, so I would say the majority are content with around 3 or 4 properties.
Mm,
Because again, they're just looking to supplement their existing financial plan.
right.
Those who are like hardcore aiming for 10 or more properties,
Yeah.
it'd fall into, fewer than 10%, I
Right.
would say.
Right.
Because, they're a special breed of people.
Right. Right. And I asked that because, I've been asked a lot about like our iWin group, for example. A lot of people think it's about being that hard, that the driven person that wants 10 or more properties, but it's not, right?
Yeah.
Like in my opinion, this is the best place, and conversations like this, I think people still need to hear it, even if they're planning to doing 1 to 4 properties. Because myself, I was a self-taught investor when I first started, and it was horrific. I'll share that
Okay.
story another time. And
Right.
then, what are the strategies that you're seeing for your clients that are the ones that are pushing for 10 or more property? What kind of property strategy are they implementing?
Well, there's a couple. So my strong advice to anybody who has an intention to build a empire
Hmm.
is that along the way, you need to start engaging partners before you run out of money. And so, um, you know, and the best time to position a property, and I've personally done this with a partner, is go sign up a property that you are 100% happy to buy and close on,
Hmm.
and take that deal to your potential partner and say, we've been talking about doing this for a while.
Hmm.
I'm going to buy this property, but I'll let you buy it with me if you want.
All right.
That's a great position from which to negotiate with a joint venture partner, in that you're going to do this anyway, but you're going to let them in on this deal.
Hmm.
And that means that you have to have the ability to close.
Hmm.
If you are at the absolute end of your qualifying capacity, you won't be able to negotiate from that same
Right.
position.
Right.
So engage joint venture partners well and truly before you need them. That's number one. Number two is accept that there'll come a time when you're going to run out of the ability to qualify with standard lenders. And we may then have to look to the alternative B-type lenders that you're looking at.
Hmm. Hmm.
And it means that there will be fees involved and
Hmm.
rates will be higher.
Hmm.
But when you do the math, many times, well, and I've done this many times, a B lender is your cheapest joint venture partner.
Hmm. Yeah, and we don't have time to get into that.
Yeah.
That is such good advice. People just see the rate and they just refuse, and
Mm.
they'll go pay more income tax in order to get an A lender. We won't get into that. Do you mind? Can I ask you about private lending? You offer
Yeah, sure.
private lending? Because I know,
Yes.
because I may go down that route. Can you touch on what private lending is and what it is you can do for people?
Sure. So on the private lending side of things, well, there's two sides to it. If you are needing to borrow money and you don't have the ability to qualify with either A or B lenders for whatever circumstance, there are private lenders who will lend regardless of your income position.
Mm-hmm.
They will lend purely on the value of the asset.
Mm-hmm.
And as such, they're taking on a lot more risk than the other lenders. And so their rates are going to be higher. Their fees are going to be higher. For a first mortgage, we're starting at rates of around 6% plus,
Mm-hmm.
and usually, 8% plus.
Mm-hmm. Mm-hmm.
So, private money is there. And sometimes our hardcore investors will take that private money because they know that, they're going to convert the property to a legal duplex, at which point they can then get income recognized and can walk that deal back into a B lender or an A lender. So there's a place and a time for that money.
Mm-hmm.
On the flip side, we help investors who have that money place that money into into private mortgages. And in turn, they can earn, upwards of 8 or 12%, depending on the level of risk that they're willing to take.
Mm-hmm.
So we can facilitate both sides of those transactions.
Fantastic. And how can people follow up with you?
My website. So you just Google my name, Dion Beg with 1 G. So that's DIONBEG. And my website is mortgagesbydion.com.
And I'll post Dion's links in the comments, or I may just edit the show description so you guys can follow up with Dion should you have questions on mortgages, private lending, anything else. Why RSPs won't cut it.
Sure.
Thanks again. Thanks everyone for tuning in. Thanks Jacob Brandy. Hello gents. James, happy to help. And Travis, happy to do these things. So, again, we'll probably be doing these, hopefully weekly as experts are available to us. And, as always, feel free to send in your questions. All right. Dion, thanks so much again for doing this.
Okay. Good to see you. Bye
right.
for now.
Have a good night.